There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them. Another way
Welcome back, traders and investors. We have Jay Hatfield on the line. He's from InfraCap MLP ETF fund. He manages that. Jay, how you doing this morning?
I'm doing well, thank you.
Thanks for coming on the show. Could you just give us a little bit of your education and your background in the markets?
Yes, I graduated from Wharton Business School, majoring in finance, and I started at, my first job was at Morgan Stanley after business school, and I joined the utility group there and did utilities, but really focused more of my time on infrastructure companies like power companies, midstream MLPs, and other non-regulated companies in the energy industry. I was there for 10 years and then was recruited to run CIBC Oppenheimer's Power and Utility Group. This is both in investment banking. And then through some contacts there, ended up working at a hedge fund that focuses on utilities and energy and master limited partnerships called Zimmer Lucas, and ended up being the head of fixed income research there, and then was recruited to run a mixed portfolio at SAC Capital that focused on energy-related bonds and equities like MLPs. I did that for 3 years, and then 6 years ago I started InfraCap, and we both run hedge funds, this mutual fund that we've launched, active ETF that we recently launched, as well as we manage through a general partner a publicly traded MLP called NGL Energy Partners that we founded. I founded together with Mike Krimble and Brad Atkins about 3 years ago.
Okay, could you explain MLPs, how long they've been around, and why they're formed, the advantages, and are there any disadvantages?
Okay. The law that restricted publicly traded MLPs to energy-related assets was passed in 1987, and they've slowly grown over the last period to be a very large industry. The reason they've grown so substantially is that investors have found them to be attractive because they own long-lived assets with substantial franchises. So I guess the most easily discussed asset would be a long-haul pipeline, either crude or natural gas. So the assets are long-lived, they have rights of way, and they typically have contracts associated with them. So they have a sustainable business model through time. And then they're able to grow as the U.S. Energy industry continues to need capital. They grow over time. So it's an attractive mix of yield and growth that is hard to find in any other type investment. In terms of the disadvantages, in fact, we've seen that very recently. Sometimes the stocks become way more volatile than their underlying businesses, and they trade more like energy stocks and way less like utilities. And so you have to be able to stomach some volatility. The second thing is that if you own individual stocks and not certain ETFs or mutual funds, then you have to file K-1s, which is difficult to do if you're filing your own taxes. It's a complicated partnership return and substantially complicates your tax return.
Okay, so they've been performing very well for really up till 2012. They were beating the market. Now they underperformed in 2013. How are they doing in this topsy-turvy market in 2014, just overall?
Well, it's interesting that we're having a call today because they've rallied about 10% in the last 2 days. So I would have said that they were flat, but they're actually up 11.9% year-to-date. Total return, that includes dividends. And that does speak to the volatility. But what I think investors should think about is not really beating the market, but think of it as more an absolute return product. in that one should expect to get returns of 10 to 15% over long periods of time. For instance, in 2012, the index was only up 4.9%. 2013, the market was very hot. They were up 27.6. But if you take those two returns and average them, you're really looking at a 15% return, which would be on the high end of the historical average. And the way you get there, it's not complicated. If you get 5 to 6% yield and 5 to 6% growth, then you end up with a low teens return. So it's really an absolute return type investment. So if the market's very hot, you're going to underperform. If it's multiples declining and there's concerns about growth, then MLPs are likely to outperform.
Okay, boy, you went a huge expansion, really from 18 companies in 2009 to 113 now. Do you think that was too much, too fast, and there could be some contraction in the industry?
Well, the good thing about that expansion of the publicly traded companies, there's some build out of infrastructure, but most of the MLP received their assets from major oil companies. So it's not like there was just tremendous building boom. There was more of drop downs from the majors and spinouts. And secondly, the U.S., well, not just the U.S., but the global oil and gas industry is fundamentally dynamic because every well that's drilled is always in decline. So there's always a need, regardless of the overall demand, there's always a need for new drilling and new infrastructure around the drilling. And also with the improvement in technology around fracking and other drilling technologies, there's many more opportunities to find oil and gas throughout the world. So that creates the type of dynamic that allows for continued expansion and continued high return investment opportunities for MLPs.
Wow, what about the drastic decline in oil prices? Do you see that affecting the profitability of the oil MLPs?
Well, the upstream E&P MLPs should really be thought of as another way of participating in exploration and production with just a little bit less risk in the sense that they typically hedge for out 2 years and then distribute their cash flow. So the near-term effect would be relatively limited. If oil prices were to decline, say, below 80 and stay there over long periods of time, then in the long run, those E&P MLPs might have to revisit their distribution level.
Okay, discuss the move by Kinder Morgan, and they came out, they made the move, and the street really overshot on the perceived benefits. Was that something that you had in your portfolio, and why did the street overshoot on that news so much?
Well, I think that whether or not they overshot is yet to be determined because the mergers haven't closed. I think that after they close, what's likely to happen is that KMI will trade better. It'll get added. It'll be its weighting will be increased in the S&P. It'll become one of the more liquid ways of playing energy infrastructure. So I think that the actual success or failure of that move is not yet determined. And I think, though, that one misperception about it was that perhaps it was a vote of no confidence by Rich Kinder in the MLP structure. But really, it was unique to his set of companies in that the operating subsidiaries or GPs, or LPs rather, of his GP were undervalued. And for MLPs, since they're growing, they're very dependent on the valuation of their equity for making acquisitions and even for providing equity for their own build-outs. So he wanted to optimize his cost of capital, and that's why he purchased those subsidiaries. And I think he thought they were undervalued. And if you look at his track record, he has an excellent track record of buying assets at attractive prices. So it wasn't necessarily a invalidation of the MLP structure, but driven by relative valuations in the market.
Okay, so when you're investing in MLPs, I guess you just have to keep an eye on interest rates, and from what we've seen, the markets are not going up anytime soon. But will a small rise in interest rates have a devastating effect on MLPs, and does it, justify the risk reward ratio?
Well, it's a little bit complicated in that it depends really what spread MLPs are trading over Treasuries. For instance, right now they're trading about 350 basis points over Treasuries, depending on which index we look at, an equal weighted index, including some of the smaller companies. And that historically is pretty attractive time to buy MLPs. They normally trade about 300 basis points over Treasuries. So in this market, MLPs are going to be driven more by energy stock prices, because there is a fear that low energy prices could impact their operations. And also, a lot of hedge funds own energy companies and MLPs, and they've been forced to liquidate, so there's a lot of selling of MLPs. And so then if rates rise from here, I would say it would be almost no impact, because it's really just an end of the fear trade that was in the Treasury market. If later in the year or next year MLPs start trading at a tight range, like 250 or 200 over, and Treasuries rise, then that's likely to be negative. But it wouldn't be catastrophic. That trade-off would be not significant. But it is, you can be profitable to time the market a little bit and buy MLPs when they're at wide spreads and sell them when they get at super tight spreads to Treasuries.
Okay, all right. So to end this interview here, is there any MLPs that you'd like to, bring up as maybe ones that maybe we should have had you on yesterday before the big pop, but any ones that investors may want to research and take a look at as a potential investment? Because I tell you, I am. I mean, those sounds like pretty nice returns to me. I'm not the guy looking for 20, 30% in the market. You could book me 5, 10, 12%. I'm ears wide open.
We have two ideas that are worth looking at. The first is more of a core holding that you could hold literally for most of your life, which is Plains All America. It's in the crude transportation and storage business, which is a very stable business, and has declined recently at the market. It yields 4.7%, and we're projecting that it should grow at 9% over the next period. And it's also a very liquid, large, well-managed company. It has an investment-grade rating. So that was sort of the more conservative core holding. If you're looking for more growth and more of a situation that's timely, Targa Resources GP recently acquired Atlas Energy. That merger is pending, and that acquisition is going to raise their near-term growth prospects to 35% over the next 3 years annualized, according to our estimates and guidance from the company. So that's one that's worth looking at. If you want to buy that, you can either buy TRGP, or it's a little bit riskier, but you can buy Atlas ATLS, because there's a merger arbitrage and potential for, as the merger gets closer to closing, to get even more attractive returns than TRGP.
And are there any's to avoid?
We're not going to single out any single names, but what we would say is some of the non-traditional companies that have come public recently that don't hold strictly energy assets and other asset classes can be riskier if they don't have long-term contracts and stable franchises. So we would just avoid particularly if you're more a conservative investor, the non-standard MLPs.
Okay, we've had Jay Hatfield on, and he's the manager of the InfraCap MLP ETF fund. Jay, thanks a lot. This is something that we don't talk a lot about on the show, and it's definitely certainly an alternative investment that investors should consider. Have a great day, a great weekend. Thanks for being on Benzinga's Pre-Market Prep, brought to you by Charles Schwab.
Thanks for having me. I appreciate it.